Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Welcome to the deep dive. Today, we're moving past the big headlines on the Consumer Price Index and plunging directly into the corporate finance office.
Right.
We're going to analyze how inflation stops being this abstract macroeconomic concept and becomes a brutal immediate pressure point on corporate spreadsheets.
That's the mission today. And the sources we have are they're rich with detail on how finance professionals, CFOs, analysts, planners are basically forced to overhaul their entire operating model.
Yeah.
We're looking at the direct hit to profit margins, the complexity of managing debt when borrowing costs just soar, and some of the really radical countermeasures companies are deploying to stay afloat.
I think everyone in corporate finance has had that moment. It's not a memo from the Fed that makes it real.
No.
It's when every single input cost you have starts rising all at once. Your logistics team calls about fuel surcharges, procurement says material prices are non-negotiable, and then HR walks in talking about cost of living adjustments. It's chaos. And it fundamentally changes the job of the finance team. Inflation doesn't just raise costs, it introduces this extreme volatility.
Which is poison.
It's poison for any kind of long-term planning. It forces you to rethink everything. Your pricing, your working capital, your debt structure, and, ultimately how the market is even valuing your company.
Okay, so let's unpack that chaos. Let's start with the most visceral impact that squeeze on corporate profits, on the margins.
The first line of defense that gets breached is always the gross margin. And that's driven almost entirely by rising input costs. Every company relies on materials, components, logistics. And when inflation hits, those costs just balloon.
And it's worse for some than others, right?
Oh, absolutely. If you have a really long, complex global supply chain, the impact is just magnified. The friction and the cost of moving goods around the planet become exponentially more expensive.
I was genuinely shocked by some of the data you found on logistics during that 2021 to 2023 surge. We're not talking about small 5% increases here.
No, not at all. The sources noted that some companies in manufacturing and consumer packaged goods, even retail, saw their freight costs spike by 5 times. 5. How can any finance team build a reliable forecast with that?
You can't.
Yeah.
You really can't, unless you have a way to pass those costs along almost immediately. But then you've got the next wave hitting you.
Wage inflation.
Exactly, the compounding factor. In a tight labor market, your talent demands higher wages to just keep up with their own cost of living. For a labor-intensive business like a huge distribution center or a fast food chain, this isn't a minor thing.
It becomes the #1 cost driver.
It quickly becomes the largest variable cost you have.
That's so true. We saw sectors like hospitality and retail just get hammered because wage growth was dramatically outpacing their ability to actually grow revenue. But that raises a question, doesn't it? Did they just have lower pricing power than, say, a manufacturing firm that makes some kind of specialized part?
Precisely. That's the core of it. If you're selling a commodity service, you just have less leverage to pass on those costs. But whether you can pass them on or not, you're still facing rising operating expenses. Your UPEX.
Right, the stuff people forget. Utilities, rent.
Utilities, commercial rent, insurance renewals, maintenance contracts, IT services, it's all subject to inflation. So even if you do a stellar job controlling your cost of goods sold, if your UPEX rises faster than your revenue, your overall operating margin still gets compressed.
And shareholder value erodes. So, okay, we've covered the expense side of the income statement.
Right.
Let's pivot to the balance sheet. Let's talk about the cost of capital itself. Because inflation, especially when it's persistent, it triggers higher interest rates. Central banks raise rates to cool things down.
And that means the cost of all money goes up. New loans, refinancing old debt, it all gets more expensive.
And this is where it gets really structural, isn't it?
This is where it gets very structural. That increased cost of money directly hits a company's fundamental valuation model. Every single investment, every M&A deal, every capital project, it uses the weighted average cost of capital, WACC, to figure out its value.
It's net present value, yeah.
And when interest rates rise, the WACC goes up, which means fewer projects are actually viable. It literally shrinks your list of profitable opportunities.
And that volatility in the rate environment just poisons the whole calculus.
It really does.
We saw finance teams, shifting aggressively toward fixed rate debt to try and lock in costs, or they just delayed all discretionary borrowing completely, just waiting.
And that was for the companies that had a choice.
Yeah.
The real pain was for companies that were caught with huge amounts of variable rate debt when the rates spiked.
Oh, that's the nightmare scenario.
It is. Their interest expense line item just exploded almost overnight, eating into profits no matter how well they were performing operationally.
I was really struck by the sources noting that in some industries like airlines or big telecom companies, interest expense could suddenly become the single largest line item on the income statement.
That's how big the risk is. It's a powerful illustration of an unhedged debt structure in an inflationary cycle, which brings us, directly to cash management.
Okay.
In a high inflation environment, cash is a rapidly depreciating asset. I mean, the money sitting in your bank account is losing purchasing power every single day.
So it forces a return to fundamentals.
Strict working capital discipline, exactly.
So working capital isn't just about efficiency anymore. It becomes like an actual inflation insulator.
That's the perfect way to put it. If you can accelerate your collection cycles by even a few days, the cash you get has more purchasing power before your own input costs rise again.
So finance teams get laser focused on inventory, on payment terms.
Laser focused, optimizing inventory, adjusting payment terms with suppliers and customers. It all becomes a competitive tool. Working capital discipline is a proactive hedge against that short-term cost pressure.
So once the bleeding starts, companies have to respond. Let's talk about those strategic countermeasures.
Right, you need a mix of offense and defense. On the offense, the critical tool is strategic price increases. And this is so much more complex than just tacking on 5%.
It's a science.
It's a science. It requires sophisticated real-time analytics on price elasticity, on what your competitors are doing, and segmenting your customers to find where demand is inelastic.
The smartest companies get that price isn't just a number, it's a reflection of value. We saw consumer brands doing these very targeted, staged increases while also adjusting package sizes.
Shrinkflation.
The dreaded shrinkflation, yes. Or introducing premium tiers. It kind of shifts the conversation away from just the price point and more toward perceived value.
And that careful staging is so vital to keep your customers. But defensively, finance has to forge much tighter partnership with procurement. This means aggressively negotiating long-term pricing contracts or, diversifying suppliers to reduce dependency on one volatile source.
And this leads to that massive structural change we've seen since the pandemic. The whole corporate playbook has shifted from pure cost efficiency to supply chain resiliency.
A huge shift.
Companies are now willing to accept higher initial costs to nearshore production or deliberately build up bigger inventory buffers.
But that's a huge trade-off, isn't it?
Yeah.
Nearshoring has its own risks. You could have higher labor costs, new regulations. You lose that global optimization. Do the sources seem to agree that the stability is worth the immediate margin hit?
For many, yes. Especially if you rely on high-value components or you're facing geopolitical risks. The volatility risk is now seen as just unmanageable in some sectors.
So the higher but predictable costs of nearshoring become a necessary investment.
Exactly. They're re-engineering the entire supply chain to manage risk. They see it as a long-term operational hedge. Okay, so let's get into some real-world examples because the playbook really is tailored to the industry. Take a giant like Procter & Gamble. They executed those staged price increases, but their core insight was this. They kept spending aggressively on marketing during the price hikes.
That strategic pairing is profound. P&G basically made a conscious decision to accept a short-term margin dip to preserve their brand equity.
Because they knew that's what gives them long-term pricing power.
It's the only thing that does against generic competitors. They hedged inflation with their brand quality. It's brilliant.
Then you look at Chipotle. They increased menu prices multiple times to offset huge labor and ingredient inflation.
And people just kept coming.
They did. The brand loyalty was so strong that customers accepted the increases with almost no drop in volume. It just shows that in food service, perceived value and quality can trump price sensitivity.
Absolutely. And then you have the sheer power of scale. Look at Walmart, the classic example. They leveraged their massive size to negotiate better supplier terms. They could demand concessions smaller retailers couldn't even dream of. They absorbed some inflation to keep their price leadership rep, but they protected their overall profit through just unmatched efficiency and automation.
We also saw very specific financial plays. Delta Airlines, for instance. Fuel is this massive, volatile cost for them.
An existential threat, really.
Right. And Delta used sophisticated hedging futures, options, swaps to stabilize that cost. They turned an unpredictable threat into a predictable budgeted line item.
And while many were focused on their home market, you had a company like Nestlé managing volatility with its incredibly diversified global supply chain. They could stagger price adjustments in different regions based on local conditions.
Their global footprint was their hedge.
Exactly.
Other companies had to be more, surgical. We saw Target take these immediate aggressive inventory actions and margin resets when logistics costs just blew up.
Just clearing the decks to absorb the shock?
Yep. And Unilever used flexible pricing models paired with product innovation. The consensus is clear. There's no static playbook. It's a dynamic toolkit.
So let's dive a little deeper into that toolkit. Let's talk about the specific hedging instruments. Financial hedging is just crucial for managing those external commodity risks.
Right.
Companies use futures, options, swaps to mitigate their exposure to things like jet fuel, aluminum, copper, agricultural products. All of it. This is all about converting price risk into predictable cost certainty.
And on the financing side, it means proactively managing your debt structure, like we talked about. Shifting from variable to fixed rate debt is just essential to stabilize financing costs when rates are rising.
You're moving a massive variable from your cost equation, which lets you actually plan for the long term again. But, effective inflation mitigation, it goes way beyond the Treasurer's office.
You need operational hedges.
You absolutely need operational hedges. And maybe the most impactful one is investment in automation and productivity. When wages are rising rapidly, reducing your labor dependence through robotics or advanced software becomes this massive competitive advantage.
It's a long-term hedge against structural wage inflation.
That's it.
I also find the evolution of pricing tools just fascinating here. Retailers, e-commerce platforms, they're not waiting for a quarterly review anymore.
No, things move too fast.
They're deploying dynamic pricing algorithms that can adjust prices daily or even hourly based on real-time demand and cost inputs. It prevents that immediate margin compression.
And for BD sectors, they're building resilience right into the contracts. We're seeing a huge rise in contracts that include index-based, inflation-linked adjustments.
It's automatic.
It protects margins automatically. It eliminates those painful quarterly renegotiations between suppliers and customers that can just destroy relationships during high inflation. So if you're a finance professional or a strategic operator listening to this, what's the ultimate takeaway?
I think it's that inflation forces finance teams out of the accounting chair and into the cockpit as strategic operators.
Yeah, that's a great way to put it.
Your professional focus just shifts dramatically. You have to become an expert in every single cost driver, build flexible forecasts that can model multiple interest rate scenarios, and partner directly with procurement to assess every supplier and contract risk.
Inflation is undeniably disruptive, but like those P&G and Chipotle examples showed, it's also a powerful forcing function. It makes management teams challenge every single core assumption, drive huge efficiency improvements, and ultimately build much more resilient business models.
Financial accuracy is always important, but the core lesson of an inflation cycle is that true success requires financial agility. It requires radical adaptation. Exactly. So before you close out this deep dive, take a moment and just consider, what assumption in your own business planning about your margins, your borrowing costs, your supply chain stability needs to be revisited right now because of future inflationary pressure.
That's the real work.
That critical self-assessment is the real work of resilience. Until next time, stay analytical, stay adaptable, and keep leading in finance.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.